So the main source of income for insurance firms remains the premiums which they receive from the insured parties. In your definitions, you came across so many terms, but the one which I consider to require some explanations are these three. The commission on reinsurance, done what? Insurance ceded, and commissions on reinsurance, done what? Accepted. Then there is unearned. There is what we call unearned premium what? Reserves, which are also known as reserves. They are known as reserves. Reserve for what? And expired risk. So what you have written, these are the most important elements which require some small explanation. So commission ceded, what have you written? Can someone read? On commission ceded, what have you captured? Someone to read for us. Come on, some here. Well, okay. They are the commissions received from insurance firm, while the commissions accepted and the commissions done what? Payable to the insurance firm. Check this. I normally use this example here. Let's say that we have CIC, for example, insurance. Normally like using Q here. Then let's say we have here foreign investor. Then here we have Kenya Insurance. So now KQ has insured all their planes with the CIC. But in the event of anything, CIC will compensate. Is CIC capable of compensating KQ if they lose 10 planes in one day? It is possible. But thinking about that, sorry. Yes, sir. So KQ, you have said if they insure all their planes to CIC, in the event of risk occurrence, CIC will not be able. So what CIC will do, they will reinsure so that they will share the risk in the event of anything happening. So when CIC receives premiums, let's say KQ is giving CIC premiums of 100 million, CIC may decide to spread. They spread the risk by giving Kenya premiums of how much? 50. There are so many reinsurance firms in Kenya, you know? So if CIC decides to reinsure themselves with Kenya Insurance that they're giving them premiums, then what Kenya Re should do, they should give CIC what? Commission. So the commission we receive as a result of the premiums which we are giving, that is called commissions on reinsurance, done what? Ceded. So when whatever you receive as a percentage of what you are giving them, that is ceded. So ceded is received based on the premiums you are paying. Ceded biashara umeleta, I'll give you commission based on the percentage you have given us. So in the question, the examiner will be mean, they might just tell you that commission ceded was at the percentage of what? 10%. Then they keep quiet. So they fail to tell you it is 10% of what? So it is 10% of the premiums which you are giving the insurance what? Firm. Then accepted normally arises this way. Let's say we have a foreign company or a foreign investor. The only insurance that person knows or that entity knows in Kenya is Kenya Re. But insurance firms are not allowed to insure individuals. They only insure insurance firms. So Kenya Re will not decline this business. Instead, they will take up the business, but they will transfer it to another insurance firm. So when they get the premiums, not necessarily they have to receive, but they can direct these people that go to CIC. So when CIC receives the premiums, they have received as a result of referral from Kenya Re. So what CIC will do, they will give Kenya Re what? Commission. That when you get those people, always refer them to us and we'll give you commission. So the commission which you are paying as a result of premiums you are receiving. So you can might have confused. You pay the commission based on what you have received. So I always advise students of these two, just master one. And the one to master very fast is this one here. Then the other one is the opposite. Accepted. Do people accept? Do you accept to receive or you accept to pay? Huh? People accept to receive or accept to pay? See, to pay. Receiving, do you people accept that yes, we have obligation and we have accepted to do what? To pay. So accepted is payable. And we have said what you are paying is based on what you are receiving. Then the opposite is not at all. Then reserve for unexpired risks, what you have written there, this is normally a provision you make on the assumption that what if these people will fail to pay? If they fail to give us the premiums, then we should have available funds to cater for any claim which may come thereafter. Once we do a nice question, it will come up nicely. Let's check that question 1 in the handouts. Let's check question 1 in the handouts. Let us check question 1 in the handouts. So question 1 in the handouts says, Tango Insurance Company Limited engages in general insurance business. The following trial balance was extracted from its books as at 31st March 2014. We cannot read that entire trial balance, complete waste of time. Additional information, premiums outstanding as at 31st March 2014 amounted to 1.5 million and 700,000 for marine insurance and fire insurance respectively. Claims intimated and outstanding, intimated are those which, the claims which have been approved but are not yet paid. So the fact remains they are always outstanding. So claims intimated and outstanding as at 31st March 2014 amounted to 750 for marine insurance and 480 for fire insurance. An earned premium, that is reserved for unexpired risks, is maintained at 100% and 50% of the net premiums for marine insurance and fire insurance respectively. Commissions on both the insurance ceded and insurance accepted is at the rate of 5% of the premium. The directors have proposed a dividend of 10% on the outstanding share capital, no problem. The tax rate applicable is 30% required. Revenue accounts for both marine and fire insurance for the year 2014. Profit and loss account, then the statement of financial position. There we go. So right there, Tango Insurance Company Limited. Revenue. They want revenue accounts. So have that. So how many revenue departments do we have? 2. Marine and which one? Fire. So let's combine them in one. So we have here marine. Allow us to have the other side which one? Fire. Shillings are in which ones? Thousands. So have that. Have that. So the main source of income for insurance firms, you say is which one? Premium. So start with premiums in that order. So premiums. Premiums. For premiums, we go to that trial balance. The one you don't pick is the unearned premium reserves. Any other insurance, bring them as income. If paid, you subtract. So from top, there is direct premiums done what? Received. So say here, direct premiums. Direct premiums. Direct means from the insured parties. So direct premiums. Marine we received how much? 40, 45, and this one? 35. Next, there is reinsurance premiums done what? See, also you add, it's an income on our side. So reinsurance premiums, reinsurance premiums. This is 1,200. This is 800. Then we have reinsurance premiums done what? Paid. So reinsurance premiums paid. That one we do what? Less. So that is 800. That is 500. You subtract. Look for anything called premium, except the unearned premiums. You set them aside first. I'll tell you how to deal with them. Premiums. Are you seeing any premiums in the trial balance? Yes. The last one, the last in the trial balance, premiums outstanding. So outstanding premiums, outstanding premiums. When? The date is very important. So this is the balance brought down. Sure. So balance brought down, those are the ones which are not been received by last year. So if they are still appearing in the books, don't bring them as income for this year. You subtract them, then the one you add is the outstanding at the end of the year. The reasoning is this: you check outstanding at the beginning, then closing. So you add this minus this one here to get for the year. So brought down here is how much? 800. So that one you less them the books out there. This one here you bring 700. Then check for me the additional information. The outstanding premiums at the end of the year, the ones we had not collected. Not one. Premiums outstanding at the end. So outstanding premiums. Outstanding premiums. Carried down. This is 15. Then the other one is 700. So it is the carried down minus brought down for you to get for the year. Question, there is nothing on premiums. So what you get is called net. So this is called net premiums. Net premiums. Net premiums. So you can calculate and let us know. I have people with answers. The first one, 56. The other one, 38. 3800. Then there is the element of an earned premium reserve, or the reserve for an expired what? Risks. We said it is the amount which is set aside. So what you have received, you be cautious. You say that what we have received, let's not eat everything. We set aside some funds in case of anything. We have available funds to pay. So in that case, you check how much was the unearned premium reserves at the beginning of the year. At the beginning, 48 and 25. So these are reserves which had been set aside last year. They are still appearing in the books right now. So they are recognized as unutilized what? Funds. You know, we had set aside last year to cater for any eventualities. Then they are still appearing in the books this year. So it means they have not been done what? Utilized. So you add them back. So that brought down you add. Then the one you are making, the provision you are making for this year is the one you do what? You subtract. The check note number 3. In note 3, they say unearned premiums, that is the reserve for expired risks, maintained at 100% and 50% of the net premium. So that is the one you're making at for this year, which you subtract, the funds which you set aside. But the ones which had been made last year, you add them back because those funds had not been done what? Utilized. So you add an unearned premium, an unearned premium reserves brought down. Those ones you add back. 40 what? 4,800, and the other one, 25. Then you less the one you are setting aside for this year. So for this year, at the end of the year, you have reserve for unexpired risks, which is the unearned premium reserves carried down. They have said what percentages? 100% and 50% of the net premiums. So this one here, but this one is quite friendly. They don't normally mention it's a percentage of what, they just say 100%, 50%. So it is normally a percentage of the net. So the net you receive, set aside, this one they have said set aside what percentage? 100. So the whole amount is not to be utilized. We set it aside. Then this one they have said we set aside what percentage? 50. So we are setting aside how much? 1900. Therefore, gross revenue, we are done with premiums. You can call it A. So gross revenue yeah, this one will be 48 because this one has died with this other one. 48 and this other one 44. Correct. So in the revenue account, you start with the premiums. And the main expense for these firms is which one? Claims. So you come to claims in that order, actually. You go to claims. So check for anything calling itself claims. So claims, we need it as an expense. So you add all the claim expenses together. So check from top. Check from top. We have claims outstanding. So claims outstanding when brought down. So those are claims for last year. You subtract them, you add the closing so that you get the increase. So brought down, you subtract. How much is this? 800. And the other one is 540. That is not an expense for this financial period. Next is which one? Claims. So claims paid. Claims paid. Claims paid 24.70. Then we have 1800. That is an expense for this year. Then we have legal cost incurred on what? Claims. So legal costs on claims. Legal cost on claims. How much is this? 180. And this is 130. Then survey expenses relating to claims, the same. So survey expenses on claims. Survey expenses on claims. Survey expenses on claims. How much is this? Or is marine only? So this is 320. Nothing there. Bad debts, no. Check. Trial balance, I think we have exhausted. So we are only remaining with note number 2. So check note 2. Note 2, claims intimated and outstanding. Intimated means they have been approved, but they have not yet been paid. Amounted to 750 for marine and 480 for it. So 5, that is an expense for this year. So claims intimated, how much? 750 for 80. Fisher. So can you add, I don't have space, so you write down here, net claims. Net claims, then what you get, call it B. So work out that. How much? How much? Right? 20. 1860. 1870. Close that one, call it B. Then we go to commissions in that order. You start with the premiums, you bring claims, you go to commissions, then I'll tell you what's next. So, come to the commissions. Just write there commissions. So commissions, we have two of them. There is the commissions done what? Ceded and commissions accepted. Sure. So sure. So we start with whichever, any. Note number 4, commissions on both reinsurance ceded. So reinsurance ceded and reinsurance accepted is at the rate of 5% of the premiums. So you need to know, ceded we said, ceded we are receiving or we are paying? We are receiving. So we receive based on what? It is on these two. They are based on these two. So we receive based on which one? Which premium? Premiums reinsurance premiums. So which one? With the one we are paying or the one we are receiving? The one we are paying. So you receive commission based on what you have done. What? Okay. So take that one. It was what percentage? 5%. So take 5% of 800 and 500. So this of this, and give me those figures. 40. 40. 35. Just working on 35. Then accepted. 25. Where are you like? This is 25. Then let's go to accepted. Accepted, you pay based on what you have receiving. Yes. So it's a percentage of this, 12 and 8. So 5% of this, 5% of this. Right? 60. The other one is 40. So I hope hapa tutasumbuana sana. Just write for me here, net commission. Net commission expense. Net commission expense. Check what is happening. Here, we have paid 40. No, we have received 40 and we have paid 60. We have received 25 and we have paid 40. So if you check it keenly, the net position remains to be an expense. You have paid more than what you have received. So use the income to reduce the expenses. You can do it the other way around, there is no problem, provided you are understanding. Because the expenses are more than the income. So we can use the income to offset the expenses. So we are remaining with commission as an expense. How much? 20. And this one is 15. Call it C. Call it C. Then finally, you bring other expenses. Other expenses. So other expenses, you check expenses which you are relating to fire and marine in specific from that question. Can you check and tell me which ones? Check and tell me which ones. Yeah. From top to avoid omission, bad debts. Yes, there is bad debts. It was quite specific. So bad debts, marine, 170 and 120. 170, 120. Then management expenses. How much? 650. 580. Is there any which you can see? No. Nothing. Fine. Therefore, you add other expenses, call it D. Call it B. What do you get? It's 20, and this one? 700. So the net revenue, you will take to the profit account. You know this one departmental. So you combine and you prepare now one profit account. So you say to P&L. So to P&L, you will take A minus B minus C minus D. And that is the end of revenue account. So in each case, take A minus B minus C minus D. You have the figures. Help with the figures, please. Sema tu yuko naye. What do you get? Huh? And the other one? 1815. Is someone having any question in regards to revenue account? Because we want to go to required Roman 2. There seems to be no question. So Roman 2 or B, let's prepare P&L. So right there, Tango Insurance. Statement of profits or loss for the year ended at 1st March 2014. So shillings are in thousands. Shillings are in thousands. So you start with revenue. So revenue from marine, you have gotten how much? 10, 40. From fire, we have gotten how much? 18, 15. Can you add the total? Add that total. 28, 55. Check if there is any other income in the trial balance, investment income, any other income. Can you check to confirm? Yes, there is investment income. Have you seen it? I've spotted investment income somewhere. Who has spotted it? How much? 280. There is an investment income of 280 on the credit. Then there is nothing. Less expenses. So let's proceed to expenses. Less expenses. So less expenses. Expenses. Can you identify expenses which were not specific? From top to avoid omission. On the debit side, expenses will be on the debit. So from top. Assembly? Let us put the expenses. Trade receivable expenses. So audit fees. Audit fees is how much? 240. Directors. There was directors fees. 490 5. Then there was depreciation. Depreciation is 905. Management was nothing. There is no any other expense unless if there is one you can see. I think those are the only expenses we have. Kindly add. So what do you get? 16. Subtract. Give us profit before tax. Profit before tax. Have you added the 280? 1495. Less tax. Tax is what percentage? 30% of 1495. So what is 30% of 1495? Huh? 448.5. Therefore, PAT, profit after tax, $1046. Profit account normally ends there. So that is how you present the profit account. Let's go to the statement of financial position. Statement of financial position. So right there, Tango Insurance. So shillings are in thousands. Shillings are in thousands. So non-current assets. Can you identify for me the non-current assets which you can be able to see? Yes? We have from from top, right? We look at investment in shares. Your investment is always an non-current asset. So investment in shares, that is an asset. How much? 1,400. Freehold property. We have freehold property. How much is this? 4,200. Then we have motor vehicles. Motor vehicles summed up to how much? 35. 35. Furniture. Furniture is how much? 1,300. Then there is nothing. Huh? Okay, machinery is how much? 1,500. So machinery, 15. Correct. Add those ones. So when you add non-current assets, it comes to how much? 11,900. Current assets. Current assets, right there, current assets. Current assets. Sundry debtors, which is receivables. How much is that? 730. Bank and cash. So bank and cash. How much is this? 110. Then another outstanding premiums at the end of the year. If we interpret it in other words, they are premiums receivable. Outstanding premiums. So can you check how much was the premiums outstanding at the year end? Outstanding premiums at the end of the year, at the premiums which we have not done what? Received at the end of the year. So they are assets, this one. Outstanding premiums at the end of the year, this one and this one here. You need to carry it down. Oh yeah. We want to carry it down, go down. This one and this one. It's an asset to the company. So bring them here. So outstanding premiums, those are premiums receivable. So that is 15 plus 7. We get 2200. Similarly, we said even from your notes, reinsurance commissions done what? Seeded is an asset in the books. So commissions seeded, they are receivable. Commissions seeded, you add the two, that is 40 plus 25. You get 61. 65. Can you add for me those current assets? There is nothing else. Yeah, there is nothing. Add the current assets, what do you get? 31, 05. So total assets, what do you get? 15? Yeah? 0.05. Equity and liabilities. Equity and liabilities. Ordinary share capital. Ordinary share capital. How much you can be able to capture? Yeah. This 3,000. So ordinary share capital is 3,000. Was there share premium? Yes. So share premium. How much? 1,000. Then profits, so retained earnings. Retained earnings, what you will do, how much was in the books? The one they're calling profit. Profit and loss account. How much is this? 450. Then check what we got for this year in our profit account. How much is the profit? 10. Point what? 5. Minus, there was proposed what? Not 5. You know when you propose dividends, make that provision. Then you capture it as a current liability as well. So proposed dividends, they say 10% of the outstanding share capital. So outstanding share capital is 3,000. So 10% of the 3. So how much is that? Can you work out all this? Can profit and loss account. Profit and loss account is the retained earnings. How much do you get? Huh? This plus this minus 10, minus 300 actually. 11.5. Then this one. An earned premium reserve. Where's the earned premium reserve? This one. Eh? Any reserve is treated as what? Part of equity until it will be utilized. So an earned premium reserves, but at the end of the year. So at the end of the year, we pick the current down, the reserve at the end of the year, until it will be utilized, it will be treated as part of equity, 5,600 plus 19. 56 plus 19, what do you get? 70 what? 70? 75. Can you add the entire equity? Add the entire equity. The entire equity comes to how much? 696.5. Current liabilities. Were there payables or creditors? Iko wapi? So we have seen it. Sundry creditors. How much? 330. So you can have it in the middle, 330. Unaona outstanding claims, ile claims intimated, they have not been paid. So outstanding claims, can you tell me the figures? It was the last item under claims. What plus what? 750 plus, giving you 1230. Then there was current tax. Tax, they just said we provide. So check the profit account. Tax is 448 points. Then they have proposed some dividends. Proposed dividends. You got 300. The 10% of 3,000. Then here again, this one. The commissions done what? Commissions accepted. What plus what? 60 plus 40. That is how much? 100. Can you add for me this whether it is balancing? Current liabilities, when you add, what do you get? Current liabilities. Someone with a figure? 330 plus 1230 plus 448.5 plus 400. 24. When you add with equity, at 105. Where is the variation? 15,105, 15,005. We'll check the difference. 100. Which 100? The 100 is coming from where? The commission is accepted, no? check. Check your additions. Then as you check your additions, I know you will get it. As you check the additions, also check for me that other question. Check the additions properly from current assets and all that. Then check for me that other question. I'm not doing it. I will just discuss that. There's something I want us to do before we wind up. So check your additions properly. Imekuwa na mambo mingi. Mulipata hiyo difference ya 100. Bernard is saying outstanding dividends of 10%, share premium 10% to be included in the current assets. Hey, Bernard, what is that? Outstanding dividends of 10%. Not number 5. Maybe trial balance is not accurate. When there's an add your trial balance, you might find there's a difference over that 100. Bernard, no, dividends cannot be included as part of Chanana. In the one we have checked, what have you identified and expected? Now there's something I want us to do. Is there something unique you have identified? Yes? It's just the direct premiums received. Yes? Number 5, unearned premiums, you only reserve an expired risk, consisted of 44.2 for fund balance, reserve for unexpired risks, and 5.5 for additional reserve. The policy of the company is to maintain the fund balance at 50% of the net premiums and to adjust the additional reserve upwards by 5%. See, guys, what you do, you take the 5% of the net which you have gotten, and note this is only for one. It is for one. So just take 5%, 50%. Then what you get, they'll say the additional reserve you adjust upwards of 5% of the written premium. So the net, again, you take 5%, then you top up. So the 42, the 5.5, those ones will not be applicable. That is what they mean. Legal expense. You can try. So, only we have to get a solution. Yes, you can try and send you a solution. There is something I want us to check. I cannot finish without checking. Though Anwaura is saying, Anwaura anasema nini? Fire total to P&L was not supposed to be, it's supposed to be 2815, not 1815. That is what she's saying. When she took A minus B minus C minus D, she's getting 2815, not 1815. People are refusing that. Ugenya, commission on reinsurance accepted. Seeded, I think you wanted to say seeded and accepted should not be treated in the revenue. They should be treated there. You and Maura ni correct well. And your 100 is not an issue. Maybe trial balance. At your time, just add trial balance. You may find even the trial balance is the one which is wrong. So let it not be an issue, provided major format when your revenue account in end. There's something I want us to do. Write for me there. IS 29. There is something small. We can deal small, but it can bring problems. So once we check this, so right for me there, IS 29, I was looking for this actually. Hyper. Hyperinflationary economies. Hyperinflationary economies. Hyperinflationary economies. So right there and say the objective of IS 29, the objective of IAS 29 of IS 29 is to establish specific standards, for entities, reporting in the currency, entities reporting in the currency of a hyperinflationary economy, reporting in the currency of a hyperinflationary economy, so that the financial information provided is meaningful. Full stop. Another hyphen. Most entities prepares their financial statements. In historical costs. Which is considered to be the initial costs of acquisition, or transactions, full stop. Another hyphen, under historical cost accounting, under historical cost accounting. Sometimes it's popularly known as HCA, historical cost accounting. Let's just try it, I will summarize. Under the historical cost accounting, comma, items are expressed. Items are expressed. Items are expressed in terms of the cash which was used to acquire the assets. In terms of the cash which was used to acquire the assets. Or paid to settle liabilities. Or paid to settle liabilities. Full stop. Another hyphen. This may not reflect the current values of the assets. This may not reflect the value of the assets and the liabilities. May not reflect the current values of assets and liabilities. May not reflect the current values of assets and liabilities. Full stop. So what we are talking about, mostly, you find that in the financial statement, unaandika sales for the whole year. But a whole year we don't take how many months? 12 months. So people take, you will take the sales in January, you add sales in February, all the way to sales in which month? December. In December, the values, the transaction cost in January are considered to be what? Historical, because that will not be the current market what? Market values. So most companies, even assets, you find that they take the assets, they don't restate the figures, they just record the figure the way it is. Sales and other expenses are recorded the way they were incurred, which does not reflect the current market values. Limitations of HCA, just like HCA, historical cost accounting. Limitations of historical cost accounting. Limitations of historical cost accounting. Number one, it does not consider the current replacement costs of items. It does not consider the current replacement costs of items. Number two, it fails to take into consideration. It fails to take into consideration any costs which have been incurred, to modify, the assets, since its date of acquisition. Full stop. An hyphen down there, you say, in view of the above limitations, comma, financial statements should be restated. Financial statements should be restated. In order to take into consideration, price level changes. Price level changes. Full stop. Subtopic, restatement of financial statements. Then you say, a restatement A restatement is the adjustment. Is the adjustment made? Is the adjustment made on the values of the assets and liabilities? Made on the values of the assets and liabilities. Values of the assets and liabilities in order to reflect the current purchasing power. The current purchasing power. The current purchasing power, in bracket CPP, to reflect the current purchasing power, CPP. Full stop. Another hyphen. This is done by applying a general price index. This is done by applying a general price what? Index. This is done by applying a general price index, provided under the current purchasing power. Under the current purchasing power. Full stop. Your price index wanapeana from treasury, wao ndio wana come up with those index. Another hyphen, CPP ensures. CPP ensures that all the items in the financial statements CPP ensures that all the items in the financial statements with the exemption of monetary, from the word money, monetary, with the exemption of monetary assets and liabilities, with the exemption of monetary assets and liabilities, monetary assets and liabilities are to be restated for the changes, in the general price index. In the general price index. Full stop. Subtopic, restatement of transactions. Restatement of transactions. Restatement of transactions. Restatement of transactions. Number one, non-monetary items. Non-monetary items. Non-monetary items, in brackets, non-current assets and non-current liabilities. Non-current assets and non-current liabilities. Non-current assets and non-current liabilities are not to be restated. Non-monetary items, in bracket, non-current assets and non-current liabilities are not to be restated, unless they were acquired, before the price level changes. They were acquired before the price level changes. Full stop. Number two, depreciation. Depreciation. You know, before the change of syllabus, why I'm curious about this topic, I was just to give you notes, and that was it. Before change of syllabus, we're just writing this, we discuss the historical, the current purchasing power. But in the current syllabus, you see they have said including financial statements. So one has a small computation there. That's why I'm very curious about it. So those you need to understand those restatements, because I'm going to come up with a small question to work out. So depreciation is restated depreciation is restated. Using the price index, depreciation is restated. Using the price index, depreciation is restated. Using the price index applied for the respective asset. Using the price index applied for the respective asset. So if motor vehicle you are restated using 2.1, the same 2.1 is what you will apply for depreciation. Next, monetary items. Monetary items. Monetary items in brackets, income, expenses. Income, expenses, current assets and current liabilities, close the bracket. Income, expenses, current assets and current liabilities are translated using the average price index. Are translated using the price index. Using the price index or price index on the date of occurrence. Or the price index on the date of occurrence. Full stop. So we only translate the monetary items, income, expenses, current assets, and current liabilities. But non-current assets and non-current liabilities, you only restate them. Restatement, you reflect the current. You say this transaction took place last year. Inflation imekuwa kali. Mafuta sasa hivi nimesikia ni kubaya. Si ndio? So if you had made a sale or a purchase and you had not used it by then and you want to sell it, Treasury watakupea the current economic index, you restate it to reflect the current what? The current price or purchasing what? So that act of translating, you don't record in historical. When you record in historical, any company using historical, it means they record as per the transaction without making any adjustment. But if the country is undergoing inflation, it is advisable that the government comes up with a price index so that in your financial statements, all transactions should be translated to reflect the current what? Purchasing power. Down there, advantages of current purchasing power, CPP. Number one, the values presented in the financial statement, the values presented in the financial statements are considered to be more objective. Number two, the restated assets provides a more meaningful basis of comparison over time. And finally, CPP avoids subjective valuations. CPP avoids subjective valuations because a single price index is applied. Full stop. Limitations of CPP. Limitations of CPP. Limitations of CPP. Number one limitation. It is based on indices, the plural of index. It is based on indices which are more statistical in nature. Which are more statistical in nature. Number two, the selection of a suitable price index. The selection of a suitable price index is difficult. It's difficult. And number three, it addresses changes in general price levels. It addresses changes in general price levels. Which may not be reflective of specific items. Full stop. We are almost done with the theory. Another subtopic, right, for me, indicators of a hyperinflationary economy. Indicators of a hyperinflationary economy. Ukifika tu kwa hiyo inchi, ungoji kuambiwa indicators of hyperinflationary economy. Just a minute. Ukifika tu kwa hiyo inchi, unasema tu hapa kuna inflation. What can be the indicators? That is, in fact, yo mkwe nayo chonjo. What can be indicators of a hyperinflationary economy? At the price iko juu. Ukifika kwa country ya wenyewe utajuaje price iko juu? Si utasema labda hapa inakuanga hivi. Atukiona 1000 ya Kenya ukifika ukiexchange unapewa pesa nyingine na gunia. Mpaka unauliza hii ya neighbor ya mtu wako nyuma yangu ama ni yangu. Haya sawa. Andika hapo number 1. The general population we have to finish this, so just bear. The general population prefers to keep its wealth. The general population prefers to keep its wealth in non-monetary assets. Prefers to keep its wealth in non-monetary assets, e.g. buildings, Hiyo kitu cha pesa kubwa sana. They can ask anything from there. E.g. buildings, or in a relatively stable currency. Or in a relatively stable currency. Mimi nasema high food prices. Or in a relatively stable currency, full stop. So ukienda kwa nchi karibu kila mtu ako na nyumba. There's something they are avoiding. So ndio. Na ukiwatisha pesa hawana, but they have the buildings. Number 2, the general population regards monetary. The general population regards monetary amounts, not in terms of the local currency, but in terms of a relatively stable foreign currency. In terms of a relatively stable foreign currency. Full stop. Number 3, sales and purchases are restated. Sales and purchases are restated. Sales and purchases are restated using a price index. So ukitengeneza tu vitabu kwa hiyo country unajua na umefanya nini? Have you adjusted with the index? That is an indicator of hyperinflation. Next, interest rates, wages and prices. Interest rates, wages and prices are linked to price index. And finally, the cumulative inflation rate over 3 years approaches or exceeds 100%. Full stop. Hebu angalia kama unaweza master 3 points there. Nimesema ni hotspot. Wacha nione nini. Kila mtu ameshika kwa ajili ya kufurahisha. Watu wa Limoni, mwalimu ananiambia ako na nini after this? Limoni. Okay. Disclosure requirements. disclosure requirements. Nancy, you will manage. Disclosure requirements, number one. So what you have to disclose if your country is under inflation. One, gains or losses on monetary items. Gains or losses on monetary items, you will have to disclose. Number two, the fact that financial statements, the fact that financial statements have been restated. The fact that financial statements have been restated must be disclosed. Must be disclosed. So you must tell people the financial statements above have been done what? Restated. Number next, a disclosure on whether the financial statements, Damaris class is being recorded, so don't worry, even if you have missed something due to network problem, you will get them. A disclosure on whether the financial statements are based on the historical costs, or current purchasing power. And finally, something you have to disclose, I repeat, a disclosure on whether the financial statements are based on the historical costs or current purchasing power. That is HCA or CPP. And finally, the price index used for restatement. The price index used for restatement. Full stop. Correct. So it ends there. Now, there is last semester in the maneuver to get some computation, because they said at least we should try to see how we can restate a financial statement. So there's a question I got, we had worked it last semester. Actually, that's what I was looking for. So what I can do, something small. Let me take a nice picture of it. You are to me, plus the solution up on that. Restatement, not our price index. That inventory, you restate with the 2.1. So you just multiply, you get the current, then you restate. So I think I can share, instead of wasting a lot of time, I can share that question plus that solution right now when we are here. So that one can work. Ikikushinda, reach out on me. But here's the question. I know things which are stubborn on you. The way I know you people, those are small issues. I know what you are capable of and what can be stubborn. So I'm sharing everything plus the solution. So let me just share right now. Because early morning come up on a class, that is quite dangerous. So, even in Mulimaliza, SG, LM. LM. Ndio maana unasema fayor mtakutalia kwa gari. Make sure you go through that keenly. That restatement, Sec 5. Okay. So I've shared in all groups. Just check on it at your free time. But the theory part, I want you to zero in majorly on that theory. You should know the difference between HCA and CPP. That one you have to know. Then the indicators and the disclosure requirements. Then go through that kindly. So it's a topic I could have neglected, but just for margin of safety, we have to do it. So thank you. Evening, we are still meeting tomorrow to wind up EPS. Early morning also we'll meet tomorrow in the evening as discussed. Don't forget, what were they tulishamalizana vizuri. So with them, we wish them success. Ama governor utaka kuambia watu wa day class. Prayers. Utaka kuomba. Oh, so we'll pray. So thank you. You can log out online. We are still in progress.